As far as the economic summary is concerned, there has been a bit of a slowdown in activity. In the US, retail sales have dropped, industrial production weaker than expected, consumer confidence has declined, services PMI fell sharply in February, and then there's a thing called the City Surprises Index. So that measures actual data versus forecast data. And that has been turning negative in recent weeks in the US because expectations were so elevated. In contrast, in Europe, the City Surprises Index has been increasing from a very low base of expectations. The US economy suffered a 0.5% month-on-month slump in real consumption in January, and a 10.4% surge in imports attributed to companies front-running expected tariff increases. The economy is still very much on track, though, for robust growth. Interest rates are still reducing. In Europe, we're expecting the ECB to cut its benchmark interest rates by another 25 basis points on Thursday this week. We're expecting the Bank of England, the BOE, to continue cutting interest rates at a pace of 125 basis point cut per quarter. And now, because of slowing growth, the US Fed Funds futures is looking at between 2 and 3 25 basis point rate cuts during the course of 2025. In China, the National People's Congress annual meeting kicked off today, and they have announced that their GDP target for 2025 will be 5%. So let's turn to a little bit of comments from JP Morgan Cazenove. They admit that certain activity indicators are softening: consumer confidence, retail sales, services PMIs, amongst others. The risk is of a broadening air pocket in activity, where more aggressive trade, immigration, and fiscal consolidation policies could increase uncertainty. And that, of course, is what we're seeing at the moment. At the same time, CPI has been rather hot, which could constrain the Fed's response. Ultimately, though, the activity air pocket could lead to more forceful Fed support, drive the re-steepening of the yield curve, and bullish equity market behavior, likely in the second half of the year. Let's move to Europe. As well as positive economic data surprises, there is the very real possibility of peace breaking out in Central Europe. President Trump's push for a peace agreement in the Russia-Ukraine war would affect major financial markets, mainly through lowering energy prices, especially in Europe, and of course provide a big boost for sentiment and equities in that region. I'm just going to be turning to MRB now, because they've been very bullish on Europe for quite some time, and it appears that their bullish outlook is now being vindicated. The 6 to 12-month outlook favors continuing to overweight the euro area in a global equity portfolio. Euro area stocks have further upside on a 6 to 12-month horizon, with a regional economy and forward earnings poised to improve, regional monetary conditions supportive, and valuations attractive. Two canaries in the coal mine that they like to look at. That's the financial sector, which is very big in the European or euro area indices. And those financial stocks have surged to a post-global financial crisis high. Aerospace and defense stocks have also been flying since mid-2024, with investors anticipating a major increase in EU defense expenditures in the coming years. Those are two very big sectors bellwethers to watch out for. Cyclical prospects are gradually improving. Real employee compensation is rising strongly, which should pave the way for stronger consumer spending and, by extension, GDP growth. Meanwhile, the manufacturing PMI has bottomed and is positioned to rise further as the inventory cycle shifts more favorably. And then after the German election, there is the prospect of an easing in their fiscal conservatism. So the easing of Germany's debt brake and the region's commitment to increasing defense spending could add additional growth support in the year ahead. China was battling with deflationary risks over the last 2 or 3 months, and inflation has turned positive at the CPI level, both in terms of headline and core inflation. And also the housing or the residential property market appears to be bottoming out. Housing sales are a mere 3% lower than they were a year ago, which is the slowest rate of decline since the bust in that market, which occurred in 2021. House prices are still falling, but the rate of decline is narrowing, and that is very encouraging. So let's look then at US markets. We are still slightly underweight the US versus the MSCI all-country world index benchmark weighting. So this drawdown in US markets and its underperformance isn't hurting us too badly, but we do have a significant exposure, increased, as I mentioned earlier, during the month of February. So this is from JP Morgan Cazenove. We note that US equity outperformance over the past years has been backed by earnings outperformance. Consequently, in order to be outright bearish on US equities versus others, the rest of the world's growth would need to accelerate versus the US, but we do not expect the activity gap to be closing in a hurry. US real GDP growth this year is likely to be around 2.5%. Eurozone, on the other hand, will likely stay below 1%, and China around 4%, quite a bit weaker than in the past decade. And if the trade war escalates, business confidence generally will be hit worldwide, but the US is likely to be less affected than others. Clearly, JP Morgan Cazenove still remain of the view that the US will continue to outperform, as does capital economics. They say the following: it is premature to abandon our views that the S&P 500 will end this year much stronger than it is now, and that it will outperform major indices elsewhere again in the process. We think the pro-US AI narrative is still alive, that the US economy will hold firm, and the performance of equity markets outside the US will ultimately be undermined by substantial tariffs. As such, we're not inclined to abandon our upbeat end 20 S&P 500 forecast of 7,000 points. And they even go further than that. They wrote an article just a couple of weeks ago, less than 10 days ago, with a title, The S&P 500 in 2025, a 5-figure fantasy. So 5-figure fantasy would mean that the S&P 500 would need to reach a level of 10,000 points. While our bullish year-end forecast of 7,000 assumes the index's absolute valuation will approach its dot-com era peak, that forecast is comparatively conservative based on relative valuations. So they're extrapolating slightly more bullish earnings growth than their forecast. And the upshot, once that's been put into the spreadsheet, is that it is possible to imagine a much higher level of the S&P 500 than we are forecasting. A 5-figure S&P 500 in 2025 might seem like a fantasy, but it would happen, for example, if the index's price to forward 12-month earnings ratio ended the year 30, and EPS had climbed to $340 for the S&P 500 by then. So they've got a big grid that would result in an index level of 10,200. So I think that might be slight fantasy, but the point they're making is that there's much more upside than there is downside. Bear with me. I just want to read you the segment on the tariffs. Navigating Trump's trade war. Why impose tariffs? Judging by the negative response in financial markets, it would appear to be a policy blunder. There are various reasons for doing so. President Trump is fulfilling the pledge he made during his campaign trail to the US industrial heartland. Making imports more expensive by imposing tariffs increases the competitiveness of locally made products. Tariffs also increase government revenue, which can be recycled back into the economy via tax cuts. A third reason is to reduce the size of the trade deficit and current account deficit. The reason is to gain policy concessions from trading partners. The motivation behind raising tariffs appears sound, but it is a risky gambit. US households may end up paying more for products, putting pressure on their disposable income and overall consumer spending. Consumer spending accounts for more than 2/3 of US GDP, so there will be a negative impact on economic growth. Companies which rely on imported components in their supply chains will be penalized, making them less competitive. Tariffs may also be inflationary, especially in the current environment, with the US economy growing beyond its production capacity. Inflation increased unexpectedly in January to a 3% annual pace, well above the Federal Reserve's 2% target. The biggest losers will be the US trading partners, even if they do retaliate. The US is far less dependent on trade than the rest of the world. Its imports and exports comprise 11% and 7% of GDP respectively. By contrast, imports and exports in the rest of the world comprise 26% and 28% of global excluding US GDP. % tariffs imposed on Canada and Mexico on the 4th of March are likely to tip those economies into recession. The impact on the US will be comparatively moderate, although consumer sentiment is clouding over. The Conference Board's US Consumer Confidence Index fell in February by 6.7% over the previous month, its biggest percentage decline since August 2021, in the middle of the COVID pandemic. Respondents cited concerns over trade tariffs and inflation. The survey's year-ahead inflation expectation increased from 3.3% to 4.3%, the highest reading since 2023. Economic activity data has also been disappointing. Consumer spending dropped in January by 0.2% on the month, the first decline since March 2023 and the biggest in 4 years. The Fed should always be ready to shore up economic activity with further interest rate cuts. However, the inflationary impact of tariffs has placed a temporary halt on the Fed's monetary easing cycle. After cutting the Fed funds rate by cumulative 100 basis points in 2024, Fed Chair Jay Powell says further rate cuts will have to wait until there is evidence on which direction trade policy drives prices. In theory, tariff increases should only be a temporary effect on prices, which the Fed might be willing to see past if the economy slows. Some fear, however, that once-off tariff price increases will have a second-round impact, making the inflationary increase less transitory. Appreciated consequence of US trade tariffs is the impact of an enforced reduction in the trade deficit on foreign investment inflows. Independent macroeconomic research firm MRB Partners summarizes the predicament succinctly as follows. A trade or current account deficit must have a financial and/or capital account surplus as an offset. Hence, any reduction in the US trade and current account deficit will have as its corollary a decline in foreign investment in US financial and non-financial assets.
This was the first CPI print with the new weightings. Headline CPI rose to 3.2% year-on-year in January, slightly above the previous reading of 3% in December 2024. Main contributors being housing and utilities, food and non-alcoholic beverages, and restaurant and accommodation services, each contributing 1.1%, 0.4%, and 0.3% respectively. Still sitting comfortably at the bottom end of the 3 to 6% target band, inflation remains under control and there remains scope for rate cuts in the future. Factory gate inflation also ticked up slightly in January, with PPI coming in at 1.1% year-on-year from 0.7% year-on-year in December 24. Compared to the CPI reading, the majority of the trends are the same, except for food and beverages inflation. Although it contributed positively to CPI, food inflation actually decelerated in January compared to December. However, the food component of the PPI statistic increased slightly from 4.2% in December to 4.4% in January. Although there was a small increase in the PPI figure, price pressures have stabilized at relatively normal levels and we're not too worried for the time being. As you all may remember, the PMI figure dipped to 45.3 in January, and there was concern over the manufacturing sector's ability to recover after 3 months of contraction. The same adjective has come up in February: sluggish. According to ABSA and the Bureau for Economic Research, the PMI figure dropped slightly in Feb, bringing the index to 44.7. This marks the 4th consecutive month of contraction. Softened demand, slower production due to cost pressures, and a fragile logistics environment all contributed to the falling figure. The cost pressures include higher input material prices, higher oil prices, and a weakening rand over the period, all of which put upward pressure on those costs. Many analysts have predicted a drop in the oil price for 2025 due to a global oversupply. This should help relieve some of the pressures just mentioned. It is worth noting manufacturing makes up more than 10% of South Africa's GDP. The GNU has set ambitious growth targets for 2025, thus a strong recovery in manufacturing is a must. This will require stronger domestic demand, improved logistics, and a more stable cost environment. And this links up with the next item on our list, 2024 Q4 GDP growth. SA reported that South Africa grew 0.6% in Q4 of last year. This was welcomed by the country after a 0.1% contraction in Q3. The Q4 performance was driven mostly by agriculture, finance, and trade sectors, with the main suppressors being transport, manufacturing, and general government services. That brings the overall GDP growth for 2024 to a slightly disappointing 0.6%. Although not massively impressive, It is a positive growth statistic nonetheless. But we need to ask ourselves, what is the honest truth? Most of the growth seen in 2024 was carried by the spending of South African households. Fixed capital formation is still well below the target of 25 to 30% of GDP, so all eyes will remain on the GNU as well as the upcoming budget speech on 12th of March.